Hello guys, I hope you are doing good. On April 23rd, 2020, Franklin Templeton has decided to wind up 6 of their debt mutual fund schemes, which had combined assets under management of around 30,000 plus CRs. This has created a panic in the mind of investors. At the same time has started a question, क्या mutual fund सही है? In this video, we are going to discuss how this shutting down is going to impact the unit holders, then what are its impacts on the bond market, why it happened, and so on and so forth. So if you are an investor in any of the 6 schemes or you are an investor in mutual fund, I would request you to watch this video very carefully. Before beginning, what I would like to share is, if you are new to mutual fund, then I would request you to watch my mutual fund series where I am discussing the whole stages, like right from beginning, what mutual fund is, how it works, what are the entities involved in it, what are the different jargons that are used in the mutual fund, what does that mean, each and every word, and how to select a mutual fund as per your own risk appetite. So second thing I would like to draw your attention to is this disclaimer. So all this what we are going to discuss in this video is just for education purpose only. Okay, you can pause this video and read this disclaimer, but I'm just going to go to the next slide. Okay. So which are the 6 schemes that are being shut down or being in the process of winding up? First is Franklin India Ultra Short Bond Fund. Then second is Franklin India Short Term Income Fund, Franklin India Credit Risk Fund, Franklin India Dynamic Accrual Fund, Franklin India Low Duration Fund, and Franklin India Income Opportunities Fund. The total AUM is 30,853 crores as on 31st March 2020, out of which around 10,964 crores is with Ultra Short Bond Fund. This all details can be available from Franklinton's website only, and this is the source from where I got this information. I would put this link in the description. If anyone to go into the details, what are the assets they have, you can go through the same. So these are the 6 schemes that are being wind up. What does winding up or shutting down mean? The inflow and outflow of money will be stopped in that fund, in simple words. So if you want to buy a unit in the said 6 schemes, you will not be able to do the same. At the same time, if you want to purchase some units, if you want to redeem your units, if you are an existing unit holder and you want to redeem them, then that's also not possible. Money will be frozen. So there is no movement of inflow or outflow of funds. Next question is, can the fund managers do so? Can they stop at their will? Well, as per SEBI mutual fund regulation, winding up of mutual fund scheme can be done either by a trustee, that is mutual fund managers as such. Second is unit holders with a majority of 75%. So 75% unit holders should be with the in the favor of that decision. And SEBI itself, that is Security Exchange Board of India. Either of the party can wind up a scheme. The next is, if you are an existing unit holders, how you are going to get the payment, how you are going to get your investments back. Well, it depends on the underlying assets. So each and every fund would be having some underlying assets, bond, NCP, CP, commercial paper, and so on and so forth. All this would be liquidated from time to time as and when the maturity comes, or they can be sold out at a reasonable price. So once they are being liquidated in any form, at the same time, if there is any interest received or coupon received, payment received from in the interim, so all the such funds which are being received would be given back to the unit holders. So it would be in a staggered manner. So maybe quarterly or monthly the payments would be released to the unit holders. It would be a slow process where you would get the funds back. So next is, how long this will take? Well, it depends on the individual duration of the portfolio. As you observed, all these 6 portfolio has different timelines, average maturity of the portfolio. We'll go back to the slide 1 to understand it. Like for example, Franklin India Ultra Short Bond Fund has a maturity of 0.62 years. What it means is, within half an year, so you can say 6 months to 12 months, this fund would be liquidated. That is the average maturity of the underlying assets. Average maturity, not the the longest, the average. Okay, and at the same time Franklin India Income Opportunities Fund is around 4.28 years, so you can assume a 4 to 5 years gap to fully liquidate the portfolio. That's how it is. So individual duration plays a key role in this. At the same time, if the bond market comes to normalcy, then there's a possibility that the fund could look to sell the assets at a reasonable value, because currently those assets are illiquid. They are not saleable at a good amount of money or a reasonable value. So if COVID pandemic has, is at ease, if it's settled down and the market has come up as revived, or government has took some initiative, started some schemes, anyway, if irrespective of the nature, if the bond market but comes to the normalcy and a reasonable value can be received for such instruments, then definitely there is a possibility that it could take even lesser time. But however, we are not sure how long it will take to get to reach that normalcy, to revive the bond market. So it's a very subjective matter. Next is, what led to this unprecedented decision by the fund house? Well, in market there are no free lunches, right guys? So high returns are hard to come without taking high risk. High risk, high return. Risk and return go hand in hand. So these funds have been facing. So what happened is, in these funds were having high returns by investing in a lower rated bonds or papers, and this could have one could have observed if the same was the prospectus of the said schemes were read. And what happened is, currently such low rated risk, the low rated papers have become illiquid. So there is no or very less buyers or negligible buyers to buy that asset. At the same time, funds were receiving redemption request from the existing unit holders because of economic slowdown, or they want their investments back, so on and so forth. So to honor that redemption, the fund started selling out of its liquid assets, and once the liquid assets are being sold, the liquid asset will be the assets which will be liquid would be high, which will be rated higher, like AAA and so on. Low rated income papers will not be, commercial paper will not be that much liquid. At the same time, the fund might have borrowed some money, and this will lead to a shrink in portfolio. The fund would be left with a higher proportion of less liquid and probably riskier instruments or investment. And a stage where managers started finding it difficult to meet the redemption demand without impacting the returns, they decided to close the funds. This is what the whole base scenario is. Next is, can this happen to any other scheme? Well, any mutual fund scheme can undergo same fate if liquidity crunch continues. But now let's go about the numbers. Currently, this all six schemes, if put together, are less than 1.4% of the assets under entire mutual fund. So it's a very negligible, amount. But at the same time, it is 1.4. So it's also not like you can ignore it straight away. Next is, all the funds which other than these six funds may not run as illiquid or as risky as these six schemes. So if they are invested in liquid assets, which are commercial papers which are graded in AAA and so on, then chances are they won't face this any problem. But again, anything can go if liquidity crunch continues. Even if we just recall 2008 crisis, at that time RBI came in and infused some of the funds in the bank, which in turn funded the mutual funds to revive the market. So this time also we can expect this thing to come. And lastly, we had only seen such type of scheme closures in 2018 in Sara Mutual Fund, but that was the case was all different compared to the current scenario. So regulatory intervention may come, and since I was observed from some of the TV channels, there are the mutual funds heads have already voiced with the RBI for their support. Now the next question is, what are the other investment avenues? First is bank deposit. Well, the return that you get in the bank deposits are not that meaningful. Next is gold. In gold, the prices have skyrocketed like anything in the last couple of months, so it becomes difficult to have a huge investment in that. Next is real estate. It is also not that liquid in the current scenario, so it is also not advisable. So we are not left with such better alternatives. Of course, equity is already ruled out because it's not safe from the point of view of equity market, because anything can happen. But if we look from debt mutual funds, I would say that we can still invest, but this is my own personal opinion. I would again suggest you to consult your own financial advisor. But investing in debt mutual fund, by checking out the risk and the portfolio that the firm, where the scheme is having, the fund manager, how long he's has managed the fund, their vision can help us to understand how which is a better alternative. So with this discussion, our topic comes to end. I hope you like this video. Please share your comments and share this video with your friends. Okay, if you still have any question, you can always reach to me on Twitter and Instagram, or also you can post the comment below. Anyway, thank you guys. Thanks for watching.